Focus on the relevant is closely linked to intent and purpose. What is it that you want to do? And what is it? Where is the best possible return on your investment of effort? So for example, if I look at the quizzes that we've taken over the last 2 weeks, this is an assessment of your skills. So this graph, this is called radar graph. And what I've done is I've looked at, this is just the first quiz. This is not even quiz 2. This is just the first assessment quiz, the first quiz that you took on Saturday. This graph, this person here, number 1, is the person who scored the highest. And this person here, 171, is the person who scored the lowest. And what this is doing is it's plotting your scores based on the nature, the contextual nature of the questions you answered in the quiz. So your ability to identify a problem space, document and define it, your ability to abstract information, your ability to recognize patterns, your ability to think logically and do algorithmic thinking, all of this is plotted on this one specific graph, right? I could show you scores, I could show you your percentage scores, I could show you how you've done with respect to the rest of the class. But for my analysis, my primary analysis is where is the biggest skill gap, especially in the lower percentile, especially with students and candidates who've not done as well in the initial assessment. And if you looked at this, you would basically see that there is a gap from this part, from here to here. So the lowest 50 percentile of the class is weakest where. So if I were to focus on this course as an instructor, as a facilitator, as a teacher, as a guide, where would my emphasis be in terms of building your skill set? And this is with respect to what discussion? This is with respect to our discussion here. Our discussion here is focus on the relevant. I have data, I have student assessment data, I have your quiz scores, I have your numbers, but what this plot shows me is clearly where the skill gap is. And as an instructor, as a teacher, as a facilitator, as a guide, as a mentor, understanding where the gaps are helps me make decisions on how to teach, how to assess, and how to track your performance in those specific areas where the weaknesses have been clearly documented. This is one instance, one variation of focusing on the relevant. Here's the next one. The next instance, the next variation is a little different. And it's a stark contrast to what you just see here. There you go. This is from the FTC sales table. This is not a scatter plot. These are actually blanks. These are all blanks. This is not a scatter plot. So is there any data, insight, or intelligence on this graph? If there's no data, there's no insight, there's no metric, there's no intelligence, should it be there? So if you have a report that has 200 pages that look like this, should that report be there? Should it remain? Or should you filter it out? 1 or 0. How about this one? Is this any better? So now I've added even more detail. I've actually given you additional information with respect to average month of sales, and even then, you can see that your data is a big fat 0. Should this stay or should it be removed? Should it be filtered out? So 1 or 0. 0 is right. So if you have reports that show up, present materials like this, then they have no place because they have no data, they have no metric, they have no insight, they have no intelligence, and because of that, the correct answer is a big fat 0 here and here. In both instances, a big fat 0. You shouldn't. So this is relevant. Here, the absence of information clearly shows that there is a gap in skills. Here, it is not relevant. Relevant? Not relevant. If it's not relevant, it shouldn't be in your output packet. Next topic, baseline and benchmark. So now if you're looking at data, if you're looking at reference points, if you're looking at analysis, you're looking at insights, and you want to get a sense of how does something compare with respect to a baseline or a benchmark, how do you set those baseline benchmarks? So in this specific instance, this is our FTC data set. This is sales information done on a month and year basis. This is by year, this is by month, this is total sales for a given year, this is total sales for a given month across the 12-year period. I'm interested in growing sales, so I want to get a sense of what has been the growth trend over the last 12 years on a month-by-month basis. That's my question. My question is, I want to look at growth on a month-by-month basis. How would this work? What's the right benchmark? How do I calculate growth? How do I measure growth on a month-on-month basis? So I have a couple of choices, and I want to look at all 3 or 4 of those choices, and then we can figure out what is the right choice. What is the choice that makes the most sense? The first choice is I just look at my revenue plot. So yes, there was growth here. This is my benchmark. There was certainly growth here, but 2023 has been a horrible month. Has been a horrible year. So 2023 sales are down to about $3,000 so far. 2022 they were up to about $14,000. 21 was a great year, $22,000. 20 was okay at $15,000. 17 was a good year with $20,000. 15 was a good year. So we've had a couple of good years, and then we've been sort of going under. We picked up again, then went up, then came under again, then are down again. So this year promises to be a bad year. Now, if you want to track growth, one is I've got this trend line. I can use this, but this doesn't give me the relevant breakdown on a month-on-month basis. What more can I do? Here's my second benchmark. In this benchmark, what I've done is I've calculated the sale this month, this year. So, for example, this is month number 3. And I have a number for 2014. I have a number of minus 32%. How is this calculated? This is calculated by dividing the 2003, so third month, which is March of 2014. I've taken this number and I've divided this by the March in 2013. So this month, this year, over this month, previous year. This is a year-on-year, month-on-month, year-on-year growth comparison. Is there anything that you are bothered by when you see this plot, when you see these percentage numbers? Are there any figures that sort of stand out to you, that jump out, that this does not look right, this does not make sense, there's something off in the calculations. We need to figure out how to fix these calculations. Any ideas, any suggestions? Anything that's sort of like a conker in the biryani? Let me give you a few hints. Do you see them now? Can you see them now? So if you calculate month-on-month growth, this month, this year, over this month from the previous year, do you see this big fat 2,223% growth in the month of July in 2017 over 2016? There has to be a problem there, as in who grows at 2,223% in a stable business? What about here? 2015, 1140% growth है, 1140% growth. And look at this one, 16 April, 520% growth, 488% growth, 261% growth, 280% growth. If I were growing at these numbers and this rate, I would be a very, very rich man. Clearly, I am not growing at these rates. There is most likely an issue with the underlying data set. So, for example, if I look at this number, 22223, this is 17 and this is July of 2017. What happened in July of 2017 and 2016? Let's go back and take a look. So July, this is July 27, July, there you go, this is 7:55 and we can see it. So something went wrong in July of 2016. We only had, normally, for July, our average sale, if I look at this trend, is, I would say the average is about $1,000. In July of 2016, something went wrong with our platform, with our system, with our technology. Maybe the site was down, maybe we were hacked, maybe there was some other challenge, but we only had $32 in sales. And then, surprise, surprise, in the July of next year, we had $7 in sales, which is the reason why we have this figure. This is the reason why we have this figure. And the same thing is true for this number, which if you walk through the data set, you will find out that there is a challenge. So clearly, month on month change, this month, this year, for this specific data set is not the best possible benchmark. Could we have a second benchmark, an alternate benchmark? An alternate benchmark, again, proposed, is this month over previous month. So I'm going to compare July of 23 with June of 23. So same year, but this month over previous month. So this is month on month growth for the same year. And it solves this problem. It solves the 2017 problem. So now 2017 is, sales are still down by about 46%, but it creates other problems. So for example, here, and this is the same troublesome month, right? Where you had $35 in sales. Here, you have a growth of about 1,321%, which does not make sense. 540%, 620%, 699%, 364%, 158%. 248%, 221%, 144%. These are all numbers that are too high. 638%. They don't make sense. So this doesn't work also. So we've done two methods for baseline and benchmark. The first baseline and benchmark was this month over the same month of this year. This month, this year over this month, previous year. Our second benchmark number B, is this month over previous month, same year. Though A and B clearly not work. And here's the third one. Is this any better? So at least the thousands of percentages, the 2,000%, 1,000%, 900% returns are gone. And here, what have we done? So what we've done in this specific instance, in option number C, is we've calculated this average. This is an average per month. What we're saying is, if I look at July, and I look at this July, and look at the next July, and I look at the previous July, this July, the average is about $1,466. So if the average is $1,466, how does the current month's sale compare with the overall long-term trend average? And if you now go to 2017 and you go to this 7, this 2017 says this July is down by 48%, and 2016 the $32 sales were down almost 98% compared to the benchmark baseline average. Does that make sense? So this is option number C. This is the current month divided by the average sale historically booked for that month. Now you can change the average sale period. You can just take the most recent 3-year sale. You can take the trend over the last 6 years, the last 7 years, the entire set, the most recent year, the last 3 years, the first 3 years. You can play around with the combination. The concept remains the same. The concept is, let's find out what the right, relevant, most recent, most applicable benchmark is, and then use that as a basis for calculating the difference in sales. All right. So that's A, B, and C, 3 options. The reason why we're looking at these 3 options is a lot of time we need to compare benchmarks. And when we compare benchmarks, we have to think in terms of what is the most relevant, the most appropriate, the most recent benchmark that we should use. So think carefully about this. You will actually see questions on selecting benchmarks in your weekend assessment. And when I say benchmark, there's not going to be benchmark with respect to sales, with respect to the FTC data set, with respect to the state bank data set, but benchmark with respect to a data set that you have not seen before. How do you dig and identify that benchmark? Student cohorts. I have 5 sections for ITC. How do I compare performance across those 5 sections? And then what is the right benchmark that we should use when we look at student cohorts? And what should we use if we want to track student performance? What should we use when we want to track teacher performance? What is the most relevant, the appropriate benchmark? So for example, here's a plot of your grades, and you can see that this specific distribution of grades and students per grade. And here's another plot. Different cohorts, different groups. If you want to compare these benchmarks, if you want to compare these two cohorts, what's the right benchmark you should use? So this is cohort A, this is cohort A, this is cohort B. How would you compare them? What would you compare them on? You could look at skills, you could look at scores, you could look at grades, you could look at distribution, you could look at variance, you could look at multiple other possible metrics, but again, they would all boil down to what is the purpose, what is the intent, what is the objective, what is relevant for that comparison. So that's one part. Then you've got the trend line. Now, if you think of the trend line is I have existing data sets, I have a history of data, and that data is predicting and forecasting an outlook for that trend in the future. In this specific instance, I'm looking at the USD PKR exchange rate. So if you take $1 and you go out and sell that dollar in the market, what do you get? So right now, I think depending on the open market, I think the open market rate is somewhere between $315 to $320, depending on the day of the week. If you go to the interbank market, which is the bank market, is about maybe $306 to $307. So that's two. Both of these are current rates. What is the historical trend? The historical trend started, if you look at 2017 Q4, you were at about $100. Then you went to about 22, you were at about $150. Then you were in 22 Q4, you're at about $222. Now remember, this is not the actual active exchange rate. This is the average exchange rate over a quarter. So this is the average of the exchange rate calculated and estimated over a 90-day period. That's the benchmark, right? That's the trend line. Using that trend line, what's the expectation for that average to be in, let's say, 2023 Q4? 2023 Q4, we are already at 306, 307. And this projection and this forecast, and this is old, this is dated. So this is dated, I think, most likely, given this factor here, I would say this was done in first quarter 2023. I did this in Q1 2023. In Q1 2023, the outlook was that we'd get to about maybe $270, $280 at the end of Q4. We're clearly at 306, 307. So this is no longer relevant. But it's a trend. It's a trend that we use to forecast and predict the outlook at that specific point in time, which was 2023. The reason why it's no longer relevant, the reason why it's incorrect and wrong, is because the model has not been updated with the most recent data set. So one of the other things that you have to factor in your calculations is that new data is generated on a regular basis, on a frequent basis. New models must be flexible enough to accept, to incorporate, to add, to update the underlying data set so that they can update and create a better outlook for your projections. Quick example, if I go back to the grade distribution, can I use this grade distribution, the first quiz, to predict the final grade for the class? Maybe, maybe not. Can I use this grade distribution for this cohort to predict the final grade for this class? I don't know. If you have enough of these, if you have a history of these over the past couple of years, or even if you have a history of these for, let's say, the last 6 or 7 times this course was taught, you may be able to do that. But if you don't, if the course context has changed, if the student profile has changed, if the outlook has changed, then the outlook will no longer be relevant. Your projection, your forecast would no longer be relevant. So that's 2. Here's the third one. Again, this goes back to the State Bank data set, e-commerce digital payments. So here's a trend in the growth on a quarter by quarter basis. So this is the second trend line. Here's a third trend line. This is the number of e-commerce merchants that have been, and you can see that unlike the USD PKR exchange rate, this is essentially growing at a very fast clip. Here's projected e-commerce digital payments. Remember that $150 million, the $43 million to $150 million table that we saw initially when you're looking at the analysis part, the first analysis that we performed on the State Bank data set. Here's a projection of that. This says that we'll most likely cross about $160 million for 2023 Q4. but this is based on the assumption, the same assumption of the exchange rate forecast that you saw earlier, and we saw that that was wrong. So if that forecast was wrong, then this forecast is also going to be wrong. We spent a fair bit of time on data. We spent a fair bit of time on trying to understand the difference between data and intelligence. But there is one key step in the middle that we haven't spent a lot of time on. That is on understanding and dissecting the model. When we build the histogram to get a sense of what is the likely value of an order, what is the probability that we'll see orders over $1,000 or orders about under $100 or orders above $100, we build a model using the histogram distribution of order size using the data set that's available to you. But is there more to understanding the model? So for example, what drives student grades? Remember, two pieces, purpose and relevance, right? So if the focus of the analysis is what drives student grades, what are the drivers of student grades? What part of your grade is dependent on the material you taught? What part is driven by your reference readings? How much do tutorials help? What part does preparation play? What part does time to prep play? What part does it play for the amount of time you're allowed to take the assessment? How about the time of the assessment? If I do it early in the morning, if I do it later in the evening, will that make a difference? If I do it on a weekday versus a weekend, will that make a difference? What about your attention window? Both in the class and in and after or during or pre or post the quiz. How about practice opportunities? What about instructors? What about your peer group? These are all factors that have an impact on student grades. But which one of these are relevant? And which one of these do you want to model? And the answer to that question depends on what is the purpose and intent. So if you're evaluating instructor performance, this matters a lot. If you're evaluating student performance, this does not matter at all. Then the rest of it, then everything else that is here matters a great deal. And if you're evaluating collective performance, then if you're a genius in a room full of genius, it doesn't, you'll all be sort of clustered towards the same profile. But if you're not a genius and you're in a room full of genius, you will stand out. If you're a genius in a room full of not geniuses, you'll again stand out. Understanding the model is key to understanding where you'll find the signal. In our last tutorial, when we spoke about search spaces and efficient search, we spoke about the fact that it's important for you to understand where to start your search. So similarly here, it is important for you to understand how to model the data so you have a sense of where you will find the signal or what that signal would look like. This is a growth in mobile banking application users and their average transaction size by quarter. You can see that this trend is going up. But why is it going up? What is driving that growth? Can you build that model? Can you identify that model? Can you actually create a thesis that says, here are the 5 reasons why mobile banking application users are growing and the average user transaction by quarter in dollar terms is also growing, despite the fact that the overall trend for USD PKR is downwards. What's the underlying model? Then there is, Zoom. Within the data set, within the analysis, within the insights and intelligence that you generate, zoom in on what are you solving for. So if I'm focusing on analyzing your quiz scores, what should I focus on? Should I focus on how much are you learning? Should I focus on what your skill set and where the gaps are? Should I focus on how we evaluate you, the process of evaluation? Should I focus on how you improve over a period of time? So the difference in scores between quiz 1 and quiz 2. Should I focus on instructor evaluation and see if you need help there? Should I focus on how much distance you've traveled? So how far you have come. So when you started this class at the start of this course, go back 3 weeks in time. And if I look at you now, 3 weeks later, has there been a clear change, a clear difference in your ability to attack and solve problems, in your ability to score better in quizzes and assessments, especially online quizzes, especially automated randomized assessments? So what are we solving for? What are we solving for determines the zoom. You could only find the parrot hidden in this picture when I zoom into it. You can only find that bird when I highlight it. But if I don't zoom in and I don't highlight it, it's very difficult to identify the same pattern and trend. So understanding the model is important for you to find the optimal zoom that will help you get to where you need to be. Projected e-commerce market size, transactions plus quarters. What's the optimal zoom? There's a lot of data here, and a lot of this data has come as a result of the analysis that we performed. But what's the optimal zoom? There is information and data and possibly intelligence insights here, but how do I find it? I can't find it at this level of zoom. I need to dig a lot deeper. Compare this. At the wrong level of zoom, all of this is just noise. It will not make any sense to you at all. Just throwing a bunch of meaningless numbers in front of you because you may not be the right audience, you may not be able to see what I mean, I haven't explained it enough, you don't have enough background, context, debate, you don't understand the term, the technology, or the terminology. This is just random noise to the wrong audience. But to the right audience, there is a lot of great information, intelligence, and insight here. Find the right level of zoom for that fits in with your purpose, with your objective, and with your requirements. So I'm going to quickly, I just have 3 minutes left before the class ends and your break starts and you're ready, you need to get ready for next class. I'm quickly going to go through the last key points. And we started with sins of data. I'm going to end with sins of data. You have to remember and focus on why do we perform analysis? What is the purpose and intent of finding insights? What is the purpose and intent of finding actionable intelligence? The purpose of analysis insight from our perspective, both as computer scientists, as technologists, as instructors, as founders, as people who work with computing technology, is very simple. We ultimately stand, focus, try, or attempt to influence and persuade people. We convince them to change their behavior. And when we say that, change your behavior, the objective on our part is for them to plot a new course. But it is very easy for someone to say, okay, we need to do things differently. It's very difficult to actually recommend what is it that you want us to do. What is the recommendation? What is the direction? What is the guidance? The objective of analysis on our part, the objective of the work that we do, is to facilitate this journey that starts with influencing, persuading, and convincing people to recommending and directing them. Driven by data. But not just data. Data, analysis, insights, and intelligence. This is the path. Now, to walk on this path, you need to understand that people have different perspectives, different mindsets, and we need to factor in that analysis and that mindset in the work we present. So generally, when we think in terms of working with data, we think that our work is done when we've brought the data into the system, or our work is done when we've completed the analysis. No, this is just 30%. The remaining 70% is identifying insights, identifying recommendations, figuring out how to present it, and incorporating feedback from the people that you're presenting this information to. This part, the remaining 70%, has nothing to do with technology, and it has everything to do with understanding who your audience is. What is the established narrative that they believe? What is the counter narrative that they don't believe? So think in terms of two armies, right? You're a blue army and a red army. You believe in X and you believe in X prime, the polar opposite of X prime. How would you convince the blue army, people who believe in this as a narrative, to believe in what the red army believes in? To do this, you have to understand that when we convince, influence, and persuade, we look at methods or models of signaling that are a function of who we are. So if I do things, if I like things, for example, I like running, I like reading, I like trying out new ideas, I like Scrabble. But I do this why? Because I like it. So when I play Scrabble or when I run or when I lift weights or when I teach, I'm not doing this because I want to create a favorable impression. I do this because I like it. Compare this with me doing things that I only do because there is a requirement on part of my social behavior, as I'd like to belong, I like to be part of a social circle, and because of these drivers, I would go out and suggest or think or pretend or believe that I like doing X. So this stability and instability in likes and dislikes is a function of whether we are driven by who we think we are and what we want to do for ourselves, or we are driven by what others think of ourselves. So that's the difference between self-signaling and social signaling. And both of these factors, the narrative and counter-narrative, and self-signaling and social signaling, are two really important key components of the equation that we use to convince, influence, and persuade. You need to factor both of these components in the remaining 30% of your work, in the part that deals with insights, recommendation, presentation, and feedback. This is not driven by data, this is not driven by technology, this is driven by an understanding of who your audience is. So I think that covers the bulk of our material. I think the last part is, we spoke about the distribution earlier. Remember, the distribution is not static. It reacts, it shifts, it changes. It's a living, breathing thing. You need to respect the distribution. And that marks the end of a class. My apologies for running a little late. My apologies for starting a little late given the update loop crisis. I hope you found this useful.